Great. Good morning. It's good to join you. I'm the unfortunate task, I think, of laying out the bad news and the challenges for the industry. You're going to get solutions from Jerry at the back end after the break. So my presentation is going to focus more, I think, on the risk side and some of the challenges for the U.S. housing market. And I'm going to identify those challenges in terms of macro risk, where we are in terms of the economic business cycle right now in the U.S. economy. Supply side risk, that is issues that are facing the residential construction in the U.S. that are holding back housing production, apartments, townhomes, single family homes. And then we'll look at building material pricing, which had a big impact in 2018 on the cost side and profit margins for home builders. So we'll go ahead and we'll start. This is kind of sums up the back end of 2018. If you take a look at that red line, that is the measure of new home sales in the U.S. And if you take a look, since 2011 or so, it's been on this kind of modest growth path, growing 7, 8, 9% year over year. But then that red line, once you get into 2018, right at the very end of the red line, it takes this dip down. And what we saw was in 2018, a 30-year fixed rate mortgage at 5% rather than at the high 3s or in the 4s. A 5% mortgage interest rate was really enough to take away a lot of housing demand. So it highlighted the fact that we've got to find ways to bend the cost curve, find ways to reduce the cost of construction. Otherwise, we're going to face some pretty sharp pullbacks on housing demand. The other challenge is the black line, the dashed line. That's month supply. And what you can see in 2018 is that month supply measure got up above 6 months. That is a problem. Anything above 6 months represents an elevated level of inventory. And so we got there for the first time in 2018, and that suggests that the interaction between supply and demand in the U.S. housing market is going to be fairly choppy. So let's look at some of the reasons that we got into that situation. The first is on the macro side. Now, we got good news, and I hope we'll get additional good news later today from the Federal Reserve. If you had asked most economists about a year ago what they thought the Fed was going to do to U.S. interest rates, it was raise rates 3 times or 4 times even in 2019. Well, right now it's looking like they're going to be a lot less aggressive on that. For example, today will likely be the first quarterly expected rate hike that they do not take. And the reason that matters, of course, is the fact that if they raise rates too quickly, you can invert the yield curve. And this is a simple measure of that. And it's usually a good leading indicator for a recession. So that red line is the Fed funds rate. That's what the U.S. central bank controls in terms of interest rates. And then that blue line is the 10-year Treasury. And you can see it's a pretty good predictor. Once that red line gets above the blue line, the yield curve inverts, and you typically will get a recession. By the way, one of the reasons that Alan Greenspan gets all the credit he does for running the central bank up until the very end was what he managed to accomplish in the mid-90s. He managed to raise rates, but not too aggressively, and he actually was able to hold them there for a while without causing a recession. The fact that we can point out that one time where the central bank was successful does show how difficult this is. But you can see the risk here of where we are right now. That red line has been increasing. They've been raising rates progressively, 25 basis points or so every single quarter, and we're pretty close to the point at which that yield curve would invert. So in January, when the Fed said, you know what, we're going to be more patient, we're going to undertake this pause, this was undoubtedly good news for the U.S. business cycle and certainly good news for U.S. home buyers for whom interest rates really determine the level of housing demand. Why was the Fed being more aggressive? Well, on the macro side, we have a lot of labor market risk. The red line is the unemployment rate. And it's basically hovering right around 4%, which is incredibly low for the U.S. economy. In fact, again, if you had asked most economists 10 years ago and said, could we see an unemployment rate for many months in a row that's below 4%, most of them would have said no. It would have sparked inflation. The Fed would have had to raise rates. It's impossible. But in fact, that's what we've got right now. And even more critically, the blue line is the job openings rate. That's the measure of open, unfilled jobs. I'm going to talk about that more with respect to the labor shortage in construction a little later. But that job openings rate continues to rise. And in fact, right now in the U.S., you could literally take every person who's unemployed, put them in a job, and you would still have open jobs in the U.S. economy. That's the first time that's ever happened. This is a really tight labor market. But inflation risk is fairly anchored right now. A little demographic footnote on this, by the way, and it helps explain why we have a labor shortage both in construction and the overall U.S. economy. This slide measures the growth in the U.S. labor force that's 55 and older. That's the blue line. That's up 17 million since the year 2000. And the red line is 55 and younger. And that's up less than 1 million over the last 2 decades. And who's to blame for that? Well, frankly, it's people who look like me. It's Gen X's fault. There's not a lot of Gen Xers. There's a lot of baby boomers, the people born right after World War II. There's a lot of millennials, people born after roughly 1980. But there's kind of this demographic gully in the United States of Gen Xers. So some of that dip was due to the Great Recession, but a lot of it is demographics. And that explains why the labor shortages are most intense in sectors like construction, transportation, energy development, physical types of occupations that need to recruit young people. Just for a while there just were not that many young people. The millennials are fixing that, but it's going to take time. So I mentioned the fact that the Fed is concerned about the fact that a tight labor market means higher inflation risks. But as you can see here, inflation risks within the United States actually remain fairly well anchored. We're right around 2%. That's where the Fed wants us to be. And that's part of a justification for the Fed going on pause and not moving as quickly on interest rates. The other factor to keep in mind is the U.S. expansion right now is aging. It's 118 months old. The longest growth cycle in the U.S. economy is 120 months. You can see up here 120 months. That's the one that began in the 1990s, so 10 years. So I'm going to make a radical forecast here. The U.S. is not going to go into a recession over the next 2 months. And so as a result, this will be the longest growth cycle. But it's aging, and it's showing some of those signs of an aging growth cycle, including higher cost of capital, higher building material pricing, other factors that tend to happen at the back end of a cycle. But Ben Bernanke, the former chairman of the Federal Reserve, has famously said that growth cycles don't die of old age, so we can kind of mostly ignore this. They're murdered, and who kills them? Well, it's the Federal Reserve. It's the Federal Reserve when it moves too aggressively on rates, which is why in January, when they announced a slower movement on raising interest rates, that was really good news both for the macro cycle and for the U.S. housing market. So our forecast of what we think the Fed is going to do going forward, we don't think they're going to raise rates today. You can check that later this afternoon. We have one additional rate hike in the middle of the year, and then maybe one more at the end of the year that could be pushed into 2020 or deferred entirely. I'll tell you right now, Wall Street's basically thinking that the Federal Reserve is now finished, that they're not going to raise rates. In fact, the next Fed action might actually be cutting rates as the economy begins to slow. So here's our interest rate forecast, given that's what we expect the Federal Reserve to do. The red line is the 30-year fixed rate mortgage. We think that we're going to get back to rising rates. They've come down a little bit. Right now they're right around 4.4, 4.5%. They hit 5% in the fall of 2018. Like as I said, they really did slow home sales. But we think those rates are going to rise again, and we're looking at a top rate in this cycle on the 30-year fixed rate mortgage right around 5%, 5.1%. That is going to take a bite out of demand as those rates continue to rise as the growth cycle continues to age. In terms of the overall GDP market, we're looking right now at about a 2.9% final number on 2018. I've got it at 2.5% this year. We think the first quarter numbers are going to be bad. The partial government shutdown is going to have a big impact. And then they should rebound in the second and third quarters. There's been some false stories out there about tax refunds coming in low. That was based off really terrible data. Tax refunds are actually going to be quite large, and that should help support consumer spending in the summer. And then we have the economy slowing below 2%. I've got 1.3% on this table. We're looking at a revision right now that actually might take it to 1.5. But regardless, we think 2020 is going to be a fairly slow year. Basically, again, sort of late cycle dynamics, a slowing economy. And we may have a couple of quarters where growth is negative, but it'll feel an awful lot like a growth recession. So on the demand side, how are demand side characteristics? Well, consumer confidence is pretty strong in the U.S. economy right now. We're actually near a 2-decade high. Took a little bit of a dip at the end of last year with those stock market declines, but higher consumer confidence is typically associated with buying durable goods and buying homes. So consumer confidence is in good shape. Household balance sheets are in great shape. There's some think tankers in DC who think that the run-up in home prices in the U.S. that we've seen, which are really due to a lack of inventory, by the way, but those home prices are due to the same kinds of factors that got us into the Great Recession. That's just not true. If you look at this slide, the red line is the amount of national income that's spent servicing mortgages, principal and interest payments. You can see right before the Great Recession, it peaked above 7%, and today it's right around 4%. It's come way down. So Americans are not spending as much on mortgages as they did, say, even in 2004, which was a relatively normal period. So balance sheets with respect to mortgages are actually in a fairly nice conservative position. Consumer debt is going up, and this is having an impact on the U.S. housing market. The two most important sources of rising consumer debt, student loans, which is in the green line here, $1.5 trillion of student loans. It is crowding out millennials, and it just keeps on rising. And then something that hasn't gotten a lot of attention, but we've paid a lot of attention to this one, auto loans. They're up 57% roughly since 2013. And unlike a student loan, which finances an education and raises your lifetime income, an auto loan purely crowds out the ability to qualify for a mortgage. So that is holding back housing demand. The other factor that's holding back both apartment demand and home buying demand is the fact that we've got a lot more young adults living on couches. They're living in their parents' homes. So ignore the blue line. The blue line is 18 to 24-year-olds. That's up a little bit because you've got more young people going to college. But the red line, 25 to 34-year-olds, that has nearly doubled. In fact, it's actually more than doubled over the last decade or two. And that seems to be a permanent change. I thought that line was going to come down in 2012 with a declining unemployment rate, and it has not. This is a social change. It appears to be permanent. And I'll say it again, 1 in 5 young people are now living at home with their parents. That is a striking fact. It's having an impact on marriage rates, fertility rates. I don't know a lot about this, but it's hard to get married if you're living with your parents. It's just a fact of life. So this is a real challenge for the long-run demand for housing going forward. That said, those households that are forming have really shifted over to the homeownership side. The blue bars here is the growth in the number of owner-occupants, the number of homeowners by quarter. The red is the growth in renters. And what you can see is from 2012 till roughly early 2015, the growth on household formations in the U.S. was really rental-driven. It makes sense, the demographics. The millennials were young. There's lots of them. They were in their 20s. A lot of growth in apartment construction. That's where the demand was. It's shifting now. And in fact, for the last 10 quarters, the last 2.5 years, the momentum has moved over to the homeownership side, even with those higher interest rates. So what has that done? It's caused the homeownership rate in the U.S. to actually rise over the last 2.5 years. And this is good news. Right now it's at 64.6%. There were some forecasts that said the homeownership rate this year would be 61%. The Brookings Institution, a DC think tank, well respected, was saying the high 50s. In other words, homeownership rate continuing to fall. And we said at the time, 2013 or so, that's wrong. That when we go out and we test consumer surveys and look at preferences, people want to become homeowners. It's just a question of whether we can provide the right inventory for them to actually be able to purchase a home. The geography of homeownership is actually quite complicated. I don't get invited to California a lot. I'm based in Washington, but part of the reason. Red is bad on this map. So this is county level homeownership rates. And what you can see here is in the West Coast, you've got lower levels of homeownership. And part of that reason is cost. It's more expensive in terms of a regulatory impact fees, and just the cost of buying a home. And the result is you've got a larger share of people living in rental units in apartments. So there's a lot of complexity at the local level in terms of the demand for housing. Housing affordability is the key issue for 2019 when it comes to housing markets. Now, this is the NAHB Wells Fargo Housing Opportunity Index. It's an affordability measure. It's basically the percent of new and existing home sales that are affordable for a typical family. You can see it peaked at a level of 78 in 2012, meaning roughly 8 out of 10 new and existing home sales were affordable. Today, it's a level of 57, so we're just below 6 out of 10 home sales being affordable. And we think, we've done some simulations on this, this number is likely to dip below 50 sometime this year. So we're currently at a 10-year low. It's likely to get worse if my interest rate forecast is correct. So the demand side conditions for U.S. housing markets are going to get more challenging, and that is going to continue. And the same kind of geography there that you saw for the home ownership rates. This is the local measures of our affordability index. Again, red is bad here. You can see the coastal markets are the places that are least affordable. There's places in the Midwest that are the most affordable, but there's some surprises on here. Go look at the state of Idaho. You can see the Boise market, it's in red. Why is the Boise market listed in the same category as some of these California markets where affordability is challenged? Well, the reason why is because we've seen population movement from Seattle and Portland and California to places like Utah, Idaho, and Montana. What happens when people vote with their feet? They push up the prices of the local area, but the incomes don't go up, so affordability goes down. And that's what you've seen in Boise. You've got declining affordability measures, and that's a real indication that in those local markets, even though nationally housing inventory is elevated, you need a lot more housing inventory in those places. The home building markets in the mountain states right now are actually fairly hot. They're small markets. There's a lot of growth there, and it's being driven by population trying to escape some of those least affordable markets. All right, supply side issues. And we're going to start with lumber pricing. Lumber pricing in the United States in 2018 was basically on a roller coaster ride. We saw an uptick in lumber pricing. This is the Random Lengths composite index for softwood lumber. It took an uptick in early 2017 because of that 20% tariff on Canadian softwood lumber. A third of US lumber comes from Canada. So that tariff had a big impact on pricing. The market priced that in. And then in 2018, we saw pricing shoot way up again. And some of this was due to the fact that the tariffs remained in place, but there was no corresponding increase in sawmill employment, which still remains right at 93,000 workers. It barely moved over the last 3 years, and not a lot of growth in output. So you've got volatility in that market, and then when the housing market slowed because of those higher interest rates, lumber pricing came way down. So right now it's kind of inching off of some of those lows that we saw after that the correction effect. My expectation is with it being down right now, or I'm sorry, up just 2% since the start of 2017. You'll see on some additional slides, other building material pricing right now is up about 6 or 7%. That lumber pricing in the US is going to go up in the coming months. OSB pricing right now is actually down 18% 2017. It's had that same factor. Gypsum pricing is up 6%. This gives you a good baseline of where maybe some of these material pricing should be. Concrete pricing also up 6%. Again, we don't have these tariffs effects, but here's one where we do have a big tariff effect. Steel pricing, used in remodeling, used in apartment construction, up 27% since 2017. This is the China effect. This is the impact, the tariffs that the Trump administration have established, real impacts for developers in terms of their pricing side, in terms of the cost of construction. And then when we add it all together, basically overall residential construction right now up 7% since 2017. See that little dip at the end? That's the declines in lumber pricing, brought it down a little bit in aggregate. But overall, what we're seeing in the US is the cost of building homes continues to rise, and that's contributing to that affordability crisis. The other factor on the supply side that the industry has been struggling with is the labor shortage. This is the job openings rate in the construction industry. It's the measure of open, unfilled jobs in construction. Right now, there are 300,000 open, unfilled jobs in the construction industry. And you can see that rate, it continues to rise and rise and rise. In fact, for the last 2.5 years, the job openings rate has been higher in the US than it was at the peak rate right before the Great Recession. So the labor shortage is here, it's going to persist, and it's going to be ongoing, and we're going to be looking for solutions. I know Jerry's going to be talking about this more during his presentation. The other factor that's contributing to this is not just bodies, though, in terms of the construction industry, is the fact that we have to find ways to build more with less. That red line is the measure of construction worker productivity that we calculate using census data. It's basically flat since 1993. The blue line is the growth in overall worker productivity using the same measurement. It's up 30% since 1993. So basically, the construction industry has not generated any productivity gains. The result is that it's harder to raise wages for construction workers, and it's harder to recruit additional people into the industry when wages aren't growing. So we've got to recruit new people into the industry to get the new framers, the new plumbers, the new electricians, stonemasons, land developers. All of those occupations right now have shortages. But we also have to find ways to build more with less, both on the land development side and the construction side. The other supply side issue that's really challenging the market is regulatory costs. They've grown 29% from the 2011-2016 period. In fact, for the typical newly built single-family home in the U.S., about 24% of the final price is due to things like impact fees, land that has to be purchased that can't be built on, delay effects, other kinds of code approvals, and other costs. Those factors are also holding back construction going forward. All right, so we looked at macro, we looked at demand, I gave you the supply side barriers. What about our forecasts in terms of going forward, and then we can take some questions. One, builders are fairly confident. This is the NAHB Wells Fargo measure of builder confidence. It's at a level of 62. It's down a little bit from right after the presidential election when there were higher hopes of tax cuts, regulatory reform, and then it took that big dip when interest rates went up. So we think it's going to stabilize here in the low 60s. Any score above 50 is positive. So it's down, but builders remain relatively positive. And here is our single-family starts forecast. So this is really where we embody all the information that I've given you so far. We think this year that single-family starts are going to come in a little bit below 900,000. It says 2% growth. It's really closer to 1.5%. It's kind of rounded up. But basically, we think we're correcting off of some of the declines we saw last fall. Growth will be constrained, and we don't see any breakout. And to give you a sense of the fact that this represents a good amount of underbuilding, 900,000 single-family starts is not really what we need based on current demographics. If you look at population growth and need to replace older homes that are either destroyed in fires, natural disasters, or just age out of the housing stock, we need 1.1 to 1.2 million single-family starts. So we're probably short right now about 1 million units in the U.S. And that's the reason the home prices continue to rise faster than income. This is the 2018 growth rates for state by state. You can see some of the material I was mentioning before about the mountain states being hot. We saw weakness in the Midwest and the Northeast. Northeast is being driven by population declines, some tax reform impacts. The Midwest, it's more trade issues. The soybean market, agriculture markets were really hurt by some of the tariffs and trade policies of the Trump administration, and that caused builders in those markets to pull back their permitting and reduced housing production. I'm going to skip this one. We might come back to it in Q&A. Some trends that are worth knowing. Single-family home size in the United States has been falling for the last couple of years. That trend will continue. We're trying to add more entry-level housing. It's tough to do. But as we add more at the entry level, median home size continues to fall. And a good example of that, by the way, is townhouse construction. Townhouse construction in 2018 grew 14%. It grew 4 to 5 times as fast as the overall single-family market. Why? Typical townhouse is about 2,000 square feet, so it's smaller, it's more dense, uses less land, and we think it's a great bridge between rentership and home ownership for those millennials that want to get out of their apartments and get into a house with a front door that they can own. Custom building market, this is high-end, higher price. It's at a market share of about 20%. This industry is relatively flat. Again, those larger homes, we're producing those. We need more of the entry level. So the custom share is relatively flat. And then single family built for rent. This has gotten a lot of hype. It's hard to go to a conference on housing without talking about it. This is builders building single family homes and holding them for rent. It's important to keep in mind this is a relatively small market. It's only about 5% of single-family starts. It's posted some growth. Historically, it's been about 3%, so it's a little bit elevated, but this is not taking over the U.S. marketplace. And then I mentioned the fact that we have a productivity problem. So it's part of the labor shortage story. This is a reminder there's a lot of growth potential here for what we call modular construction and panelized construction. Jerry's going to talk about this in a lot more detail. Modular construction is basically the whole house being built in the factory as the Census Bureau collects this data. But it's only 1.6% of total single-family starts. So here's where we can get some productivity gains. But it's a relatively small market share, so there's a lot of work to be done. Panelized construction, basically building the frames in factories and then assembling them at the work site. Only 1.9% of single-family homes. And that market share is relatively small in some parts of the country. So there's a growth potential here as well. Basically taking some of the construction activity off the work site and doing it in factories. We do think these shares are going to rise. How much? I haven't seen a forecast yet that I can completely agree with, but they're certainly going to rise in the years going forward. Apartment construction, relatively flat. It seems to be leveling off right under 400,000 units a year. A lot of growth early on. Now it's beginning to slow. If you recall that slide, I put up the home ownership and the rentership gains. So that market has got its demand potential, but its growth potential has slowed down a lot. And then lastly, remodeling. The remodeling sector is slowing. This year we've got a 3% growth rate. Harvard does a forecast of this. They've got it at 5, so a little bit faster than me. But home price gains really generate a lot of growth in the remodeling market. 2016, 2017, that's slowing down with overall home price gains now slowing down. But we've got a lot of demand there, and that's in part because the U.S. housing stock really is aging. Over the last 10 years, for example, we've got almost 40% of homes being 40 years older or more. So there's potential demand for single-family construction and remodeling. And this is the last slide. I laid out a lot of challenges: supply side, demand side, macro headwinds that can affect the market. But there's a lot of potential for growth for housing in the United States. And the reason why is pure demographics. So the way you read this slide, the vertical axis is a count of population measured in millions. The horizontal axis is age. And that blue line is the U.S. population profile. And I've divided it up into generational boxes. So for example, you can see the boomers. You can see that Gen X gap that I mentioned as part of the reason we have a labor shortage for the U.S. economy as a whole. That's that gully right there between the boomers and the millennials. I'm right there in the 40s. And then we've got the millennials, that hill and near that yellow box. That's why we talk about the millennials so much when it comes to housing demand. There's just so many of them. And their peak age right now, by the way, is right around 28, 29. The median age of a first-time home buyer of a single-family home in the U.S. is 31, 32. So over the next 2 to 3 years, despite higher interest rates and macro concerns, the demographic demand potential for single-family homes is going to grow and grow and grow. And it's just a question of whether the industry, at the right cost, can add the homes that are needed, particularly at the entry level and in higher density concentrations. So that's kind of the future that we see going forward. And with that, I'll call Karina back on stage. Thank you.